Good morning, all. My name is Deepesh Mehta. You all know us. So we are organizing this session exclusively for our clients of happy investing. And let me first introduce a bit about our speaker for today. His name is Sandeep Tandon. Sandeep is the founder and CEO of Quant Mutual Funds and has a vast experience of about 27 years in the capital markets. His journey in the money management, business his journey in the money management business started in 1992 with GIC Mutual Funds, where he was a trainee. Later, he joined in IDBI Asset Management, which is now Principal Mutual Funds, and now Single Mutual Fund, where he was a founding member and was a part of the core team that initialized the asset of IDBI. Sandeep has worked at several reputed financial services firms, including ICICI Securities, Kotak Securities, Tepco Securities. In fact, he has also worked at Economic Times Research Bureau. Sandeep credentials as a global macro strategist are well established. He has channeled his vast experience in interest, novel thinking into building his predictive analysis. This is what we are going to listen from him today. And the dynamic VLRT investment framework that he has designed at Quant Mutual Fund. It is these frameworks coupled with his deep understanding of various asset classes at global level, including credit, commodities, equities, and now digital currencies that enables a deep and definitive identification of market inflection points and arrive at a conclusive macro points. So friends, here we have Sandeep Tandon. He'll just be starting. So the format of the session is that Sandeep would be taking us through each mutual fund. Each mutual fund company have a different style. So we have invited Sandeep and asked him to share how does an asset manager and mutual fund manager design processes and fix the stocks. So over to you, Sandeep, and we'll have this session, and post this we'll have Q&A. Most of you are in mute mode, and we will unmute all of you once when we start the question and answer session. Yes, thank you so much, and you could share your screen.
To all the participants,
yeah.
If you have any questions, you can share them on the chat box and we will make a note of the questions and we will take questions at the end of this session. But so that you want to put in a question, just drop it so that you don't forget and we will answer it, get them answered at the end. Thank you.
Yeah. What do you say?
Okay, thank you. So I'll just run a very brief presentation. Okay. So I just want to, good morning, everybody. I just want to talk about how Quant Mutual Fund actually operates. Okay. We are just not for the sake of saying we are different. We just want to understand how we manage money. Okay. It's very important. We are very deep macro house. We try to understand the prevailing market condition globally. And we, very proudly, we say we are the student of adaptive asset allocation and try to see what type of environment and actually try to adapt that. And that's the way dynamic style of money management comes into picture. And if you recollect that we all are very much clear that data points are changing on daily basis. In the morning, you have to look at some geopolitical volatility, some political announcement out here. You look at the corporate actions, look at the global markets, and many more data points. So we do understand that we live in a very dynamic world, but why our money management style remain very static? And that's the way we brought the concept of dynamic style money management. If we are living in a dynamic world, we will rebalance and reconstruct our portfolio based on the prevailing environment, which means whether it's a risk-on period, risk-off period, and what is the intensity of risk-on and risk-off. Accordingly, we can rebalance and give you some perspective. So that's the way this whole firm has been designed. The being relevant is the cover page of a book which was written in 2019, but that is our philosophy. Everybody wants to keep himself or herself relevant at all point in time, which is a very challenging task. And that is something which you try to put in efforts that we remain relevant in the financial market from a longer duration period. Okay. Now let's talk about few slides that I want to talk about. Okay. Now, okay. So what is the real objective of dynamic style of money management? Okay. Obviously, everybody is looking for better returns, superior returns. what we say adding alpha and subtracting beta, which means we are trying to generate superior risk adjusted returns. And that is our objective. And that's the reason every time any investor looks at the, don't look at the outperformance part, don't look at the relative outperformance. You have to look at what risk particular money manager has taken to delivering that particular alpha, which you are very excited about. It's very important to look at the risk adjusted measures rather than just looking in isolation. So let me give you some small example of how this is a report card of the dynamic style of money management. Okay. This is just 1 week old data. Okay. So we implemented dynamic style of money management or our VLRT framework in September 2020. At the time, similarly, if you recollect, COVID hit us and we hit a lower circuit on 23rd March. So somewhere around 24 March onwards, we are trying to cover one full cycle from that day till today, how we have performed, how industry has performed, benchmark has performed, and what is the risk adjusted return. It'll give you a very clear perspective. Now, if you look at all the old schemes, right, from focus fund till active or active to focus, these are old schemes. What returns we have generated? 340 to 855% returns. Very decisive number. What is the relative to Nifty? Look at the relative outperformance, 148 to 660%. This is extraordinary. But what gives us more satisfaction is all about, look at the Sharpe ratio, Sortino ratio, Jensen alpha. What risk adjusted return we have generated? People should celebrate 1.1 Sharpe ratio. Look at, we are closer to 2 Sharpe ratio in most of the scheme. Globally, Sortino ratio of any 3, which is like, isn't generally considered very high for even long short guys. For long account, this is a very meaningful number. So that gives you perspective. And even you look at, a lot of people look at that quant was born in bull market and hence they have done extremely well. Let's see the bear market. But here you look at the calendar year returns, how 2020 was versus the benchmark versus the fund return we have given, or 2020. 2022 was the challenging year for the industry. Majority of the scheme has actually delivered negative returns. Quant was one fund house who given positive returns, okay, in the market from a longer term positive return in that calendar year, right from small cap to quantum mental, between 10 to 30 odd% return. That was the number which we have given, okay. And let's go back and look at now, even for the, what is important for a long-term perspective, if we have generated 3 months, 6 months, that number, what is look at? Look at our 1 year, 3 years, 5 years, you will see a decisive beat over the benchmark. And that is very important to understand how the dynamic style of money management works. Okay, that we have not only given extraordinary returns, but we have beaten the benchmark decisively with limited risk. And that is the real achievement of dynamic style of money management. Now let's go back and look at some more data points which I want to talk about. Okay, I'll spend 2 minutes on timing. This is a very important concept. If you open our fact sheets, the first page is this: timing is everything. Okay, we have been taught few wrong things. And first one of the important myth I want to break, that people say nobody can time the market, timing is bad, time in the market is more important. So I just want to clarify, for us, timing is a risk mitigation tool. Okay, timing is an analytical tool. And as a student of management, we have been taught right place, right time. Okay, every investor wants to time the market. Okay, this is a human tendency. For us, we believe that timing is everything and everything else is conjecture. And you have to look this statement from a risk perspective. If you have not sold your technology stock in 2021, September 2021, best of the large cap lost 40 to 60% in next 1.5 years. So if you have missed it, then you have incurred losses around that. And that's the reason when we say it's a risk mitigation tool, I will explain in the VLRT framework why we harp about timing is a very, very important tool for us. Yes, time in the market is good, but that's represent what experience you have, what the time you have spent in the market is good. But timing is a risk mitigation tool. Don't look from anything else perspective. Okay. Now, if you really look at, we very boldly say that objectivity is our religion and data is God. Everything revolves around data, okay? Which means there's no scope of subjectivity, and we bring a very mint fresh approach towards business of money management. and we are data analytic firm. Money management business is a byproduct of it. Okay. I also want to touch base, and time is very limited. We want to touch base something about the predictive analytics. Okay. How predictive analytics is different from postmortem analysis, which happens in the industry. Earning calls are given, results come, people listen earning call, and upgrade, downgrades come, and people tend to react. The other way of doing is people preempt that. Okay, I expect result will be good, or I expect result will be bad. So it's a preemptive approach. Okay. Or sometimes people take contra approach. Okay. What we do data driven approach. When we talk about predictive analytics, a very interesting concept. Let me explain in a very simple terms. In your kindergarten days, you have a drawing book, and and if you recollect the drawing book, those pictures were there where you connect the dots and the picture gets evolved. As you grow up, the picture become bigger and bigger, and then you start playing with puzzle. By the time you reach first and second, started building blocks. And this is what exactly we do through the help of predictive analytics. We connect the dots and try to see whether the picture is becoming more and more clear or picture becoming blurred. If picture is becoming more and more clear, we take a decisive bets. Okay. And when picture is blurred, we lie low. It's not necessary that you have to play on the front foot all the time. Sometimes it's very important to learn. If the risk of period, you lie low also, just protect your capital. And the risk on period, you can play on front foot and generate extra alpha for difficult time. That's the way how this entire predictive analytic thesis is built. That we talked about earth analytics, we talk about liquidity, we talk about perception analytics, we talk about sentiments, any data, anything or geopolitical volatility, anything which affects market, we try to capture that. Now, most important thought process about quant, we very candidly say that we are in the business of risk management and returns a byproduct. It's a very important statement, very important to understand, because whole industry every investor was chasing returns, and that is not a great strategy. We always believe that if you manage your risk, returns will be generated. And this is the entire crux of quant mutual fund, is all about how you manage your risk, whether it's known risk, whether unknown risk, or even perceived risk. So how you capture these data points is very important for us. Now, just to share, we have crossed 84,000 crores of asset under management. What is very important is that we have unique folio of 72 lakhs, and we have total folio of now closer to 79 or 80 lakhs. And that is a very important number from a risk perspective. The concentration risk is very low. Okay. You can understand if this is the base we have, so you can just calculate on your own that nobody owns a very sizable bet or meaningful number in our portfolios. So important from our perspective is that a very young firm was built in last 3 to 5 years time, if you look at, but in last 10 years SIP returns, we figure out in the top out of top 5 SIP returns, 4 belongs to quant. That's the way extraordinary performance the quant mutual fund has delivered in last 3 and 5 years perspective. Now I just want to touch base very quickly about our framework, which I was talking about. Timing is everything. Let's understand the VLRT framework. Before getting into VLRT framework, I also briefly want to talk about our core thesis or the core belief. So we combine qualitative, quantitative, and behavior aspect together. And we say fundamental, the Atma, liquidity, the Prana, and sentiment, the Maya. All three are important. Even the Maya is very important, but not Maya through your feel factor. Maya, we quantify mathematically, and that gives a big edge in the market. So in terms of investment philosophy, we manage money in a very dynamic style. So active, absolute, unconstrained. It is our endeavor to generate absolute return. That's the way we manage money, like a treasury. We take a decadal view, long term, short term, medium term, hedge call, cash call, special, all possible risks we try to manage simultaneously. And then we'll try to create alpha out of it. It's very important to understand where we have grown up with this thesis long term. Yes, investors are long term, asset classes are long term, but stocks and sectors are not long term. I want to break this important myth. People will say particular stock is evergreen. This is a long term bets. Okay, we can sleep over it. No, it's very important. Why we criticize this looking at long term in isolation doesn't help. Because managing long term risk is very easy. Even your mistakes are hidden if you talk about 10 years. When you manage your short term, medium term, and near term risks better, Not only you protect your downside, actually generate alpha out of it. And this is exactly what we do. We keep on generating small alpha, and that becomes a very meaningful number by the end of the year. Unconstrained, important thought process. We are unconstrained fund house, style agnostic, market cap agnostic, thesis agnostic, sector agnostic. We are pure opportunists. Wherever we get better or superior risk adjusted opportunity, we try to capitalize on that. That's the way the entire thought process of word quant come from the background. We quantify everything which affects market. We are not just a quantitative house. So it's very important to understand these theses. So that is, and another important point I also want to bring out here is about the lot of people perceive quant as a risky house, and I've showed you a number. Our risk adjusted return actually best in the industry. Other thing people talk about momentum trading. Okay, so I just want to address that part also here. We are actually an inflection point strategies. We buy and sell stocks on extreme inflection points. Okay, when we talk extreme inflection point, either stocks hits the most admired territory or stocks are trading at the most neglected zone, and that is the way when you able to identify these inflection points, your downside is protected and upside is massive open. So that's a way a data-driven organization, analytics-centric organization, that's the way we manage our money. Okay. Now, in terms of philosophical approach, if you want to measurable, reliable, everything has to be quantified. Okay. We talk about quantamental investing, how our fundamental and sentiment data can be merged through quantamental investing. Very important concept, multi-asset, multi-manager. Okay, as multi-assets are interlinked, similarly, we bring the concept of multi-managers, which means in quant mutual fund, a team delivers, not one individual. Okay, and that is the important thing because one individual has issues out here. So when we talk about multi-asset, multi-manager, it means we are not dependent on one manager, one thesis, one style, one philosophy, and that is a very important risk mitigation tool for us. When you talk about money flow analysis, very interesting thing, how money shift from one asset class to other, how we look at when we combine liquidity and risk appetite, how we can capture a money flow analytics. Excuse me. So when we talk about like how we talk about energy, it never dies, changes the form to hydro to mechanical, similarly kinetic to potential. Similarly, money shift from high risk to low risk environment. When you look at this sort of analytics, okay, where you combine the risk appetite and liquidity, it gives you a fairly good perspective how money flow analytics have been built over a period of time out here. Timing, I have briefly talked about. I'll spend 1 more minute on that. When you talk about timing as a thesis, what is very important? We talk about Pareto's principle, 80-20, the 20% stock deliver 80% return. We actually extended to the next level, say 20% time stock deliver 80% return. Those are the inflection point which I was trying to explain you, becomes very vital for us. This is what exactly we do. We have our own predictive analytics tool. Who has built? Machine has not built. Human beings have built. Machines are our support system. We don't run any algo out here. Do we use high frequency data? Answer is yes. But all calls are taken by money manager. So we use our predictive analytic thesis. We have our analytic team, which includes about research and data analytics. We have money manager. All combination, we say analysis adds up. Okay. What is important? Let's understand for 2 minutes about VLRT framework out here. Now, look at and understand that why we harp on VLRT is important for you to understand VLRT. Let me give you a small example. I have been hearing for last 6 months to 12 months period, depending which community you are looking at, everybody has been talking about India is very expensive. Answer is yes, but market doesn't fall. Then some of the analysts will give you what happened in 2000, what happened in 2007, 8 or 2018. This was the multiple in the market. This was the valuation thesis which they were talked about, and then market corrected sharply. But it's last 6 months, 8 months, it's nothing happened like that. Why it is not, you are not able to get answer if you are looking valuation analytics in isolation, and hence we bring multi-dimensional research into picture. So when we talk about multi-dimension, yes, valuations are rich. Let's introduce a second dimension, liquidity. What was liquidity in 2000 and what is liquidity in 2024? We are few hundred times of that number. What was the liquidity in 2007 post Lehman crisis, which is considered the most, all central bank came in a cohesive manner and pump extraordinary liquidity. Today liquidity, global liquidity is even few times of the Lehman crisis liquidity. Now you look at even from the, then let's bring a third dimension. the risk appetite or the sentiment data. Let's forget 2000 for time, it was a NASDAQ related thing or e-commerce related. 2007, it was a real global crisis. And India barely managed that crisis. Now, what was the perception about India in 2007-8, which was an important top for a lot of people? And what is the perception in 2024? Our absolute perception or absolute macro data is improving, but relative data, we're in a far, far better situation. Similarly, from a purely looking from a perception point of view, India is in a very unique situation. My 33 years of career, I always say I've never seen such phenomenal macro, which are very good in absolute number, but they're extraordinary when you look at it relative to China, relative to US, relative to developed market. So now you look at the combination aspect, 2/3 of the data is not showing any signs of euphoria or any signs of needs to worry about it. 1/3 is expensive. So when you look at totality, you get answer. That's the reason in our VRT framework, 1/3 weightage is given to the valuation analytic only. 2/3 is macro, 1/3 is liquidity analytics, 1/3 is risk appetite. Both are macro data. And T, the final, which is timing as an analytic tool, is a function of liquidity analytics, is a function of risk appetite, is a function of valuation analytics. Okay. And that's what is very important. When multiple data points are skewed in one direction, it gives you better timing. This is exactly how dynamic style of money management works. Okay. And it gives you a very interesting facts how data points are changing. Let me give you answer, and I'll come to the market also with this thing. Let's talk about March 2020. When COVID hit us, okay, we all know this was the greatest buying opportunity, but we all were worried about our own life. Now, if I have to decode these things mathematically, why it is very important, when event unfolds, we all get carried away at that moment. Okay, and when you sit down, postmortem analysis obviously going to be easy, and hence we have built analytics about it. So risk appetite in March 2020, one of the lowest in the history, 40-50 years low. And if I look at from extreme low point in April, it was started inching up. Simultaneously, if you look at the liquidity analytics, so courtesy central bank, any pandemic, they work in tandem. So global liquidity was lifetime high. Now, valuation, what has changed? Maybe 6-8 months or few quarters later, people realize it that something has fundamental also got changed at that moment. But at that point, people felt nothing has changed. So 2/3 data points has changed significantly. Actually, the third valuation also changed, but you could not gauge at that point of time. Now, what is very important, when you have extraordinarily high liquidity and risk appetite from the lowest point is inching up, this is a perfect background for a lethal combination, I call it, for a bull run. And that's the reason by 15th April, we were fully invested. Come May, June 2020, risk appetite further rallied. We shifted our large exposure towards mid and small scale. And that's one reason 2020-21 is the extraordinary performance. Come September 2021, when there was a euphoria globally, and what we spotted euphoria, and if I dissect the euphoria, it was not in value, it was in growth. It was in FANG companies, technology company, growth at any price stocks. And the cycle peaked out. We were also running our skewed portfolio towards growth till September, October 2021. By January 2022, we shifted towards value. And that's the reason in calendar year 2022, when value picked up, we were the biggest beneficiary and we outperformed others. Now, let's go back. How the data changed. Come June 2020, risk appetite starting bottoming out again, liquidity started improving. We talked about reflex rally in India. Come January 2023, something drastic got changed in India and risk appetite virtually collapsed. And that's the time we turned very cautious on the market and the risk off period lie low. And we also talked about that by September 2023, risk appetite should bottom out. And October 2023, we made that big call. On our monthly call, we talked about risk rally on the horizon. And till today, that cycle has played out very well. We are in the risk on environment from that perspective, and it worked well for us. Okay. So when we try to capture these data points from a global perspective, macro perspective, okay, let me show you how we capture in our investment process. So exactly what we do. We look at our global risk appetite, global liquidity parameters from the global perspective. Then same thing we look at from India. Based on the risk of environment, we try to see how to construct our portfolio as a risk on. we get into high operating and high financial leverage companies, the risk of we move toward defensive and low beta portfolio. And this entire thing of VLRT framework, right from a global macro to India-centric sector. So a deep macro, we come to sector and then to stock. That's the way this entire flow has been worked out. And if you really look at the outcome, okay, you will get answer. Look at the gaps which we have created versus the benchmark. Okay, this quant small cap index. We talk about quant active fund, okay, or any tax fund. If you look at the mid cap fund, okay, look at the flexi cap, the massive gaps which we have created versus the benchmark, the infra. At the peak of IT boom, this was the best technology. This was the best thematic fund and one of the best performing thematic fund in the country also as of today. Look at the large and mid, okay. Even liquid fund, we have been the first top quartile. Multi-asset, very decisive move as compared to the benchmark which we talk about. So it's the quantamental, another unique product which we have. We'll talk about that. Aggressive hybrid fund, okay, so on. So I will just stop it here, and I will now take it this question answer for you guys. Okay, yeah. Now floor is open for question answers.
Uh, Thanks, Sandeep. That was a nice exposure to the way you work on your funds. Thanks for that. I have one question from Harsh Jain.
Yeah.
He wants to know which could be the next multi-bagger sector, similar to what you currently shared, saying, either infrastructure or IT sector, which was there in the last few years. What would be the next in the coming years?
So if I have to get into very larger thesis, we have said very openly, if we are looking at India, we said we are very bullish for India. This decade belongs to it, maybe half century belongs to it. So two important sector, which is larger perspective. Obviously, one will be manufacturing and will be infra. Okay, if India has to grow, then both India has to, apart from being a good big name we have earned in the service sector, I think where we need is the manufacturing. I think the current government has taken a lot of steps, including the PLIs. So manufacturing, larger thesis, and infra also. Okay, these are the two themes which I say, and these are two very big, broader themes. And then you have you can get into specific sector and companies in that. But keep in mind, a lot of things are also very expensive. It's not like everything is manufacturing. You can just pull out anything, and some of the stocks have gone to the roof. So then has to be very careful about that aspect also.
Sure. This is a question from my side. You spoke about superior risk adjustment.
Yeah.
Towards returns. Now, from what you shared, we saw that you have been able to generate the superior returns. But could you put a little bit of, light on how you adjusted that risk? How did you manage that risk adjustment?
So it is a data-driven organization. I say it's very difficult to pinpoint one data points, okay? And it becomes challenging to just say in 2-3 minutes I can summarize everything, because then I say we run complex multivariance model, multiple data points are skewed in one direction. We take that bigger call. So it's an analytic and number-centric data which we look at. It's no gut feeling, no personal view. This is so whole idea of analytics is about how well I can remove my own biases, human biases, which is linked, and price is the biggest bias. So we try to dilute how dependency of this dependent variable called price has to be brought down significantly, because most of the valuation parameter has dependency on this dependent variable, and that is the biggest problem. That is something which we very uniquely try to do it. Okay, and if you really look at let me just extend this question further, and we want to talk about the outlook. So we talked about how the risk on rally continues, but it's very important for us to understand in India also the easy phase of bull run is over. Okay, when I say easy phase of bull run over, that we should not worried about that market has peaked out. No, we are in decisive bull run, but in decisive bull run we are now in difficult phase of bull run, which means anything you buy, any sector, everything has gone up in last few years. That will not be the case. Going forward, sector rotation, stock rotation will play a very vital role. Okay, as I said in the beginning, some of the manufacturing state companies are very expensive. So the way we look at some of the data points is very important for us to understand, okay, for us to understand how we are trying to build this whole thesis. Okay. And this whole thesis is all about how well you manage your risk. When we look at these data points very closely, okay, and that gives us something big answers, okay, purely from analytic perspective, not bringing any biases out here. And what is very important when we say these two sector, and we have to identify within the subsector and drill down and look at the companies, and uniquely if we can identify where which are the sector and stocks are still trading in neglected territory, which are stock have reached the admired territory. So we try to prune down the admired territory stock and try to build. Again, very important. It's very important to understand everything we look at an absolute and relative, because absolutes are important, relatives are more important. So we do get within that some opportunity. Answer is yes. As Indian capital market depth and breadth is also improving. Okay, so you will get a lot of opportunity, but very clearly and boldly, I'm saying that easy phase of bull run is over. We are in difficult phase of bull run. That aspect you have to keep in mind. That does not mean we are negative on small cap, on mid cap, like a lot of people talk about. Okay. We think if you are very bullish for India for a decadal perspective, then mid and small will outperform. Okay. If you have 10 years view, 8 years view, 5 years view, then mid and small will outperform the larger caps. But if somebody is looking for next 6 months, next 12 month opportunity, then answer can be slightly different. But you have to keep aspect in mind. So I've covered the outlook part also, which I missed out.
Sandeep, Sandeep, I have few questions to you. Post-COVID, we see the number of demat accounts in India rising up. Now we have close to 12 crore demat accounts in India. Every Indian wants to become a fund manager by himself. Okay. And as we meet people, they are very confident that, they can do, stock selection on their own. And on the other side, we have professional fund managers like Quant and other mutual fund companies. So please guide the audience on, why taking a mutual fund route is always better than doing, the stock selection on their own by buying the direct equity. Because we have seen data that, most demat accounts give returns lesser than the fixed deposit. So please touch upon those points.
So it's a very good question. Actually, even our regulator is also worried about the way option trading has picked up. So many apps have come and so many YouTubers are keep on educating how you make money. They only talk about the positive side of it. Nobody talks about the ugly part of the derivatives trading where people have lost their capital big time. So very important question, and let me address in a very mature manner. Now, two aspects of looking at. One is that if somebody within this group, people believe they are professionally qualified, they have experience, and they have done very well, they should continue. Okay. In investing on their own, because they have built that confidence or that experience over a period of time. But if somebody don't have time and focuses somewhere else with your job or your business, then I think you should depend on the professional money manager. That's what happens in the most of the developed market also. Okay, because as a professional money manager, we are more equipped than masses. Okay, in terms of our understanding, this is our full-time job, our analytical skill set, our resources which we have, this data subscription capability we have built over time. Obviously, and more and above, this is a phenomenal tax efficient vehicle. The mutual fund are the best tax efficient vehicle. I don't think one can have any better than this. But it's a very personalized thing. I always say, if somebody wants to say, I say you keep 5-10% of your capital on your own, and you see the risk. If the investment you have made in the mutual fund have they are better than on yours, if you think your performance is far better than what the mutual fund industry has done, okay, then you can increase your exposure. So it's very important for that aspect to understand. But I always say that majority of the investor, neither this is their core job nor their focus area, then hence leave with the professional money manager. If you don't have bandwidth and resources to manage your own money, if you have, then obviously you can continue. But that's a broad answer I will give it. You should have large allocation towards the money manager like us or the industry, and keep something for your own learning. As if you keep on delivering better, then obviously you can change the ratio over a period of time.
And the next most interesting, and this question is across all people. We are just 10 hours away from exit poll results and 72 hours away from election results. people are sitting on the fence and they're not knowing, what to do. Will the market fall or, will the market go up and all these things. We don't know whatever the result comes. So how should an investor take an approach during these times when, there is uncertainty in the, in the country on terms of the, election process? What is your view? How should one look?
As a macro person, every second month some election happens globally. This year is very unique. 45 countries are getting the electoral part. Journey is going on. So what is very important for us, we don't give too much weightage on these things, as hype get built around this thing. We have seen it in the past. So it's an important event which every 5 years, but it's a known event. It's a known risk. Okay, our worry only comes, it is something which is unknown completely. What is important for us to understand that neither we are too excited about it, nor we are too tense about it. Yes, event is there. And based, not only don't look at this event in isolation, look at the event in the background, what happens in the past. Okay. And that is very important for us to understand that what background we have just before this election happening. And hence, if you look at our strategy, what we have done in last few years, few months, we have moved from illiquid to liquid stock. We have reduced our beta in the system. From high beta, we have moved towards low beta. We have generated some cash also. If there's an opportunity, we'll try to capitalize. But we are not going to the election in a manner where we are saying we have hedged our position, we have shorted the market, we have bought extraordinary options, which is very expensive right now. Nothing like that. Okay. Because India macro is in a unique situation. Even if somebody feels there could be a small setback here and there, I think it could be a quarter phenomena, a month phenomena, because Indian macro is so meaningful. So India remain buy on dip strategy, and one should not get too much worked out on this narrative which is prevailing, in the market. So we are just maintain your behavior and has to be more mature in this environment and very calm. And that's the way we are entering into this, which is very nearby now. So I don't think one should try to overreact on this. The way you are doing your SIP, the way you're doing STP, you can continue. And even somebody wants to put lump sum money, it's a great opportunity because India remain very constructive. So if you have a medium to long-term view, I think I don't think one should try to time the market so perfectly. So as I said, that valuation is 1/3, risk capital is 1/3, liquidity is 1/3. That is, I've said. But within that, if you drill down, there's different further analytics. Though we specify specific weightage, no, we don't run any factor-based model out here because we think that thesis has failed very globally, whether it's factor-based model or smart beta, whatever name you want to call it. We think that is a failed thing which globally, and hence that is also part of static style of money management, that you give 30%, 40%, 20% weightage to multiple factors. That's not the way we operate. We live in a dynamic world based on the data. Dynamically, we rebalance our portfolio. We know specific. It's a very complex thing, very difficult to explain in a few minutes word, but we don't do anything like that, what you are asking.
So is there any structured process to identify the various data points that you consider?
Yeah, of course. It's a very process-driven organization. Otherwise, not possible to manage so much data on continuous basis. So there's a team on the analytics side continuously monitor data on an ongoing basis.
Okay. There's a question by Mr. Rangnath. Which says, is the VLRT model sustainable and does it guarantee higher returns going forward? Or do you see there are any adjustment based on data analytics that always plays and your model has the ability to learn through the data and provide great returns to investors?
Okay. First of all, in life, there's no guarantee for anything. Okay. And guarantee itself has I don't think one should, if you come to the market, don't come, anybody can give you guarantee apart from, so that's the thought process. I don't think we ever get into it. Now, when you talk about our own track record, yes, 28% times we are always wrong and 72% times we are right. And that's the outcome of our own analytics. So it can be measured, our success and failure. So that's the way we very openly define it, because we don't have any God status to say that we will get 100% right. It never happens. Okay. Within that, 72% is a very good success rate. That's the way we define it. What is very important to understand is that I have shown you in various slides that even in difficult time, we have generated positive returns. It's our endeavor. That's what we say. Nobody can give you guarantee. Look at the classic example, BFSI sector, which has last 1 year has not done well, except in last 2 months, still they have rallied. But if you recollect June 2023, when we launched our quant BFSI fund, and first 6 months, actually, index has delivered marginally 2% or marginally 1% negative return, depending on which index you're taking. In the same period, actually, quant BFSI fund has delivered 64% return, which was higher than the Nifty return, is higher than the small cap return. So if you look at when sector has given negative or flat returns, we have outperformed by 64% or 63%. That's a very decisive performance we have delivered, which showcase our capability and understanding about the market in terms of portfolio construct. The sector has delivered negative return. 2022 was a very classic example that entire industry, majority of the schemes had delivered negative return. Quant was the only fund house in the negative year as compared to previous 2 years of 2020-21. We generated positive return. Okay, I think that itself gives you some amount of clarity what is the success rate of VLRT framework. But from a compliance perspective, I always say we obviously never can give you guarantee. It is our endeavor to generate absolute return. It's our endeavor to deliver superior risk-adjusted return. That's the way this whole analytics sort of thought process come into picture. Try to remove human biases, so we generate superior risk-adjusted return. That's the best I can say about it.
Right. Thanks, Harsh. So we'd like to thank all the participants who made the time to join in this special session this Saturday morning. We'd also extend our thanks to Sandeep for his insights that he shared with us, for the information that you've brought forward for all of us to understand in how you work and how the quant functions as a mutual fund house. And we hope our participants have been wiser with what they have got to understand today. Deepesh, you would like to say anything?
No, I just want to thank you. Just thank the participants who are on YouTube live as well. Just wanted to say this.
Yeah, we have some people who've logged in at our YouTube live streaming as well, who we can't see here. So I think all in all, it's been a nice Saturday morning. Thank you once again, Sandeep. And I think we'll close with this.
Thanks for
Thank you.
Yeah.
Thank
you, everybody. And that we'll close the session now. And we hope to see you all next when we plan our next session soon.
Thank you. We are on time, and as we promised, Happy Investor always try to start and end at time. Thank you so much. Thank you all.